term buying signal is indicated there. Well, so that is your first entry price, 21.78 or 21.79, whatever, and your stop loss is then at the previous low, slightly below the previous low. Okay? If you're using a 2% strategy or 2% risk management rule, this works quite well. So you're risking only 2% of your capital if you get it wrong. Here, the stock's got to fall like 50% for you to lose 2%, so it's a very small position. What happens now is the stock price moves up into that area between the 10 and the 20 moving average on the weekly chart, which we're calling the buying zone. So you're going to have a bid halfway in the middle of that, or in the midpoint between those two moving averages. You're going to have a bid for another position, and you're going to put your stop loss at the previous low. In this case, it's very close to where your entry price was. You could even leave it there for now if you wanted to, but in this case, it was moved up to there. So there you take your next position, again with a 2% rule. And you rinse and repeat this every single time it enters into that buying zone. So every time it comes into the buying zone, you add a position, you move your stop loss up. You add a position, you move your stop loss up. Add a position, move your stop loss up. Eventually, it's going to stop you out. All right, so you've now added to this position 8 times, every time on a 2% rule. 6 of your 8 positions have stopped out in the money. 1, obviously, you entered there, you've lost 2%. Position number 7, you might take a small loss on or you might break even on, but you've got 6 trades that you've made a lot of money on. So that's a nice long-term trading strategy. And this is a 2-year trade. So that took a long time for this trade to work out. And if you look now, very recently, here we have another robust entry, 89-day moving average. It got you in there. The stop loss is there. Boom. Okay, so moving on. Then there's swing trading, which is almost like the halfway between day trading and longer-term trading. So this is where I think most of you guys fit in. This is where I fit in for the most part. This is like the middle of the pyramid. Okay? So what you're wanting to do here is you're wanting to identify the long-term trends, the long-term trades. So you look for trades like this, and then you try and trade with the trend. Right? So you look for the long-term trend, the weekly, the daily trends, and you trade in favor of that trend or with that trend at all times. Trades last between 2 hours and 2 weeks, sometimes longer, sometimes shorter. And you're trading on technical principles, but within a fundamental universe. So you've gone and you've made a list of stocks that meet your criteria for long-term investment based on your fundamental analysis. And in these trades, you're looking for long only, for example, or you can look for short only if you've picked a bunch of companies that you think are going to zero. And you trade with the primary trend, right? I'm saying here that it's better to not watch the trade every second of the day, because odds are it'll drive you crazy. Stop loss rules are very clear, need to be very clear. You need to stick to them. I slip up on that from time to time. Sometimes it works out to my favor, most times it doesn't. And oftentimes you could wait for 2 or 3 weeks because there's just no setups and there's nothing happening, especially if you're trading daily time frames, which are often the bigger moves. So the goal, as I said, is to identify the longer term overall trend and trade with that trend. And here your things like your Fibonacci retracements, your chart patterns, support and resistance level, trend lines, moving averages, that type of stuff comes in handy. So to give you an example of a strategy, this is one of the strategies that I use for some of the trading that I do. So this is a long-only strategy. I'm calling it wave trading. It's got elements of a couple of different things in it. So there are some Elliott Wave elements in there, elliottwave.com if you want to learn about it. Simon will think you're crazy. I don't know if I believe Elliott Wave. I do like the ABC patterns, though. They work quite well. So the rules are 25% exposure. I'll cover that in a couple of minutes. And we're basically swing trading on the ABC principle. So the ABC principle says that the market moves in waves. I'll show you on a chart in a moment. And universe shares only, which means it's shares that meet your fundamental criteria for longer term investment so that you can go long only. And because you're on a 25% stop loss or 25% exposure rule, you might not necessarily have to take your stop because you've got a long-term growth company or whatever the case is. So if you get your timing wrong, it's not the end of the world. Okay? Entry criteria. It needs a kiss of a moving average, stochastic move up through 50 or 20. I preempt stochastic a lot of the time, which sometimes bites me, sometimes doesn't. But through 50 is the safest way, and a break of resistance. So I'll show an example in a moment. Exit criteria, either you've reached your stop loss, or you've reached your pattern target, or there's a fundamental change in the business. I don't know, a telephone company gets fined $1 trillion or something like that. That might get you out the trade, or a clear trend reversal. Then stop loss is slightly below the B, slightly below the B point on the wave trade, so I'll show you where that is. And then you can use a 9-12 exponential moving average as a trailing stop loss, or if the trend starts moving in your favor, you can roll a trend line in. If it breaks that trend line, you can then get out. Then there are a couple of must-haves for your entry criteria. So you have to have these things; they must be present. Maybe not all of them, but most of them. So a validated wave pattern, multiple time frame trends. So if you're wanting to trade a 1-hour trade, for example, is the daily trend up? You're trading long on a 1 hour. Are you trading long on the daily as well? Are you trading long on the weekly as well? So you'd ideally like all 3 time frames to point in the same direction: long term, short term, medium term. Right? Same with shorts. Then you need a confirmed trend. So moving averages need to be below price. Obviously the longer term ones, the shorter term ones might be above, the 10 and 20, but the 50 and the 89 and the 100 need to be below price. Stochastic needs to be coming from an oversold position moving up, in the case of going long, and the opposite in the case of going short. Primary trend needs to be up. Fan lines I'm not really going to go into. And you are only trading the B to C move. So you can measure from 0 to A, you can measure the target. I'm scratching this thing, sorry. And of course, high probability setups, which is good risk reward, which means any trade with a risk reward ratio of higher than 1 to 2, or 1 to 3 is ideal, 1 to 4 is even better, but 1 to 2 is the minimum. So if you're risking 1 rand and you're not looking to make at least 2 rand, don't take the trade. And relative outperformance of the top 40, so this is part of my universe. It needs to match a number of earnings growth criteria, and it needs to be relatively outperforming the top 40. Then there's a couple of nice to haves and a couple of things to watch out for. So the things you watch out for are stuff that can get you out the trade. So bearish candle formations or bullish candle formations if you're short. Distribution patterns, falling volume in the direction of your trend. So if the trending up and the volume's coming down, a break of the 50-period moving average. There's a bunch of them. You can have a look at those. Also, the nice to haves, there are like bullish candle formations, bullish divergence. I like bullish divergence quite a bit. A 38.2% retracement on the Fibonacci, or slightly deeper. No deeper than 61.8 though. That's all stuff that you'll learn on investopedia.com. So go there. And then, rising volume, bullish stochastics, that kind of stuff is all the nice to have. So here's a couple of examples. Again, cherry picking. This is Kumba. So just to explain this ABC principle to you. If you look over there, you could call that point A, and then you've got that move up. Point 0, move up to A, down to B, up to C. So you could measure that and project it up. And here you've got 0 to A, down to B, up to C. 0 to A, down to B, up to C. Right? So it's moving in those sort of saagtande, like a saw. So there's a couple of things that happened here. It interacted with the longer-term moving average, which is 100-period moving average here. So your entry was slightly under 120. That was the upper limit of the entry. So anything underneath that would have been great. So it's 119. Stop loss below B. So we've got 0 here, A there. This is B, and then your stop loss is slightly below B, right? So what you're looking for here is a break of this resistance line. Stochastic that needs to move up. So I preempted this, to be honest with you. As you can see, the stochastic only just started turning, but I'm being a bit more sensitive on the stochastic because there's a bit of a bias signal there. The moving average is crossing over the signal line, or the signal line is moving over the stochastic line. It's whatever. So, and then you can put a target to it. This was quite a conservative target. And then, as you can see, that one worked out. This chart was done today. It went even higher. So I was a bit conservative there, but it's a good sort of example. Here's another one on oil. You've got a 0, A, going up for C. You've got a target, a break of resistance. It's interacted with its moving averages. Stochastic is up through 50 nicely here, and bang, it plays out. All right, so that is one sort of way. This is an open trade that I have at the moment. sort of a similar setup here. 0A coming down for B. It's got a support level. Stochastics are starting to play along. The thing is starting to turn. So it's starting to match many of my criteria. You can draw a little resistance line in there, and you've got a long trigger. So you've got 3 things telling you that you want to be long, and then you can target those highs. That's probably a bit conservative. This actually targets a bit higher, but I could be really biased on oil as well. So I don't know. So managing emotions is the next step. So I think the message I'm trying to get through here with the previous bunch of slides is you need to have a strategy. Okay, you need to sit down and think about how you're going to do things. It's like starting a business or anything else really. You need to have a plan. Without a plan, you're kind of just throwing darts in the dark. So managing emotion is a relatively important concept because I think that emotions are probably the biggest stumbling block for traders. And there's no way that you can get rid of emotions. So don't think that to be a successful trader, you need to be the stone cold sort of trader that has no feelings and just always keeps his cool. Because that's not the case. But you need to be self-aware. So there's 2 different types of definitions of self-awareness. The one is that you are aware of the impact that you have on the people and the environment around you, your actions, for example. In the market, very often your input to the market is very small, so the market is bigger than us all. So your impact on the world around you, the environment, is very small. So in the trading perspective, I suppose, self-awareness is more of understanding the emotional state that you're in, what got you into that emotional state, and how that emotional state influences the decisions that you make. Because your objective is to think rationally. Because if you're in a trade, for example, and it's going against you and it gets to a stop-loss point, you've got to be able to say, I need to walk away from this thing. And if you start thinking irrationally because you're feeling emotional about the money that you're losing, you might not make a decision that is in your own best interest. So emotional control or emotional management is really just about staying objective and acting in your own best interest, right? So I know, for example, with my biggest problem is that if I'm on a losing streak, it's fine. I can keep going. I'll dig my way out of it, and I'll start doing well. If I've gone on a hot streak and I've made a ton of money over a period of 2-3 months, then my brain chemistry changes a little bit, and I get overconfident, and I stop listening to stop losses, and I start trading too big, and then the house of cards falls down, and I got to recover, and then get my way out of it again. So that happens a lot. So this is something I think that is very important. So this is something that I put on the Just One Lap blog. I'm not sure when, last year, maybe earlier this year. The 4 A's of emotional management or emotional control. Okay, so they are acknowledge, anticipate, accept, and act. So acknowledge how you feel, right? I feel elated because I've had the biggest trading day of the year yesterday. And I feel like I can walk on water because I caught the long from the lows all the way into the close of the US session last night. Okay, I missed the rally today. Fine. But I feel great. Okay, so acknowledge that and think, okay, what can this do? Anticipate what this feeling of feeling great can do to my decision-making process. When I feel this way, I tend to trade riskier. I tend to take bigger trades. I tend to ignore stop losses. I tend to feel overconfident. So anticipate how you feel is going how that's going to impact your decision making. And also anticipate how you're going to feel if some things go wrong or if things go right. I'm in a series of trades. If I get all of them wrong, I'm going to feel really crappy. So, anticipate that feeling so that when that feeling happens, if that feeling happens, it doesn't take you by surprise. You're almost ready for it, And then accept whatever outcome it is that you've had. If you've had a couple of losing trades and you can acknowledge that you're feeling really angry and really upset or whatever about the results that you've gotten, you have to accept them at some point and say, like, you know what, this is it. I can't change it. You can't unscramble the egg. I need to sort of just accept it and I need to move on. Or you can say, like, I accept that I am feeling overconfident because I've been doing really well. And then that allows you to act rationally, because now you've learned to understand your emotion, where it comes from, and how it influences the way that you think and the way that you make decisions. And then you can get to a point where you can act rationally. So this is, I think, this is most of trading, really, to be honest with you.